We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Garrett Goggin, CFA, CMT, MBA, 15 years with Gold Stock Analyst and Stansberry Research, and founder of the Golden Portfolio. Garrett, thanks for joining me today.
Hey, Tom. Happy to be here. Thanks for getting me on.
Of course. And, after that word salad of an intro, why don't you start by giving us a little bit about your background and kind of what led you to gold and silver after your trading background?
Yeah, sure. I've always been inclined towards the alternative assets. I started out in Boston, a very conservative financial community. It was mutual funds with Putnam and Fidelity, invest for the long term and everything will be okay. But in the long term, sometimes not everything is okay, especially right now with the dollar being devalued, inflation going higher. Stocks, they've done well, but inflation adjusted, they haven't returned much. Whereas you look at commodities and, the U.S. government just keeps on printing dollars, hands over fist. The debt keeps on increasing, and it's always about the long term, what's going to happen in the long term. And it's always been far off, but it keeps getting closer and closer every day, where the dollar is going to lose tremendous amounts of value. You look at the recent political stuff coming out of Kamala saying price controls and, with the inflation rate, I have 3 kids and the food costs twice as much as it does the other day. You go get apples, it used to be cheap. Now you spend $30 for 10 apples and it's ridiculous and it's speeding up. So, gold and silver have historically been a proven store of value, and they will continue to be over the next, decades to come.
Mm-hmm. So considering this macro landscape that we're kind of facing right now, give us your 5,000 foot view of what matters most right now in the markets and the economy.
Yeah, well, I tell you what, pretty simply right now, I look at the yield curve a lot. You can look at 10-year minus 2-year. You can look at 2-year minus Fed funds. Fed funds is the Fed discount rate. And it shows the Fed's too tight. And whenever the curve inverts, it inverted in 2000, 2008, 2019, and now. Every time the yield curve inverts, there's a recession. The Fed cuts rates. The Federal Reserve basically has to double their balance sheet to take on, all the worthless assets. And, where I think we're going to see that right now is in commercial real estate. You see buildings trading for, 10% of what they were 5 years ago. And all those loans are coming due over the next couple of years. And I think the economy is going to take a serious impact because of that. And the Fed's going to have to increase their balance sheet again. And then as the Fed increases their balance sheet, gold doubles. Gold doubled the years after 2008. It doubled in the years after 2000. It doubled in 2019. And right here, it's going to double again. And, I don't like throwing out gold price targets because I'm a fundamental analyst. I'm a specialist in valuing these mining equities, no matter what the price of gold is. Mm-hmm. But, $5,000 gold, it's not a long shot. And based off margins and based off what the gold has done historically, it's easily achieved in the next few years.
Mm-hmm. So, considering this yield curve inversion, obviously, we understand it has been inverted for over 2 years now, as you said, and many understand its significance in terms of predicting this recession. But what other events or conditions does it also signal?
The other things that it shows back in 2000, 2008, 2019, and what's going to happen now, every time the yield curve has been inverted and the Fed started cutting discount rates, the market crashed in 2000, crashed in 2008, crashed in 2019. We're going to have a correction here. There's absolutely no doubt. And that's what forces the Fed to cut rates. The Fed doesn't cut rates until they have to. If the market keeps going up, they're not going to cut rates because, it's going to create an inflationary bubble. So they wait until the market turns down to really cut rates, and then they have to pile on their balance sheet. But yeah, every time the yield curve has been inverted, recession occurred, market crash occurred, gold doubled. Gold's, the place to be over the next few years.
Mm-hmm. So do you think gold doubles from here, or does it begin when the Fed starts cutting and printing? Or is gold has it already started that correction for what is coming from the Fed?
Yeah, gold's looking ahead and showing you what's going to happen. The market moves before the Fed cuts, right? When the Fed finally cuts, everyone knows they're going to cut. It's telegraphed everywhere, and gold is sniffing that out right now. That's why gold, the price of gold has increased over the past year. It's done well. It's $2,500 an ounce. It's getting ready to break out. It looks pretty good. And one other thing, my former life as a, derivatives trader, there was a group of traders. They were called the Turtles in Chicago. Ever heard of these guys?
No.
Richard Dennis started a group. Ever see Trading Places with Eddie Murphy?
Yeah.
Yeah. So it was a bet between the two guys. I can teach anyone how to be a trader. And he's like, no, you can't. That's not true. It really happened back in the 80s with the guy, Richard Dennis. And he took on 100 kids. And he's like, I'm going to teach these kids how to be traders. And the interesting thing about it, there were only like 2 or 3 rules. It was, you're buying a 20-day high. And you're managing your risk very closely, and you're shorting a 20-day low. And what happens is, the majority of your trades are stopped out at small losses, but you get 1 or 2 trades out of, 50 that end up going up 100, 200, 300. You get on a freight train, and that's buying the 20-day high. And if you look at the price of gold right now, it keeps bumping against high, bumping against its high, bumping against its high. And one of these times it's going to break out like cocoa did earlier, back in, was it earlier this year? Yeah, cocoa basically tripled, and gold is looking the same here. And as they say, there's no fever like gold fever. Things get wacky when gold really spikes higher because people lose their faith in the currency. Inflation's obviously a problem, and it's going to be interesting to see if gold follows suit.
Mm-hmm. Well, it seems like that momentum, once things really get moving, that momentum starts to come in. Obviously, there's a lot of people that I talk to that say some of that comes from investors, and other parts of it come from institutional investors. So because of that outperformance of gold, will that force those institutional guys to start coming in as well?
Yeah, a couple things regarding that. Institutions are always late to the party. These guys manage their portfolios in order to not lose their jobs very conservatively. They wait for sectors to outperform, and then they need to gain exposure to those outperforming sectors. So they always follow in late. And yeah, those institutional investors are not on board yet. If gold continues to go higher and the gold stocks do well, they're going to be forced to add exposure to the gold mining sector. Now, another thing that I've just been looking at recently, if you look at GLD price, which is gold, and it represents close to an ounce of gold, versus GLD assets or shares outstanding, right? The shares outstanding is 50% lower than it was 10 years ago at the last peak in 2011, whereas the price of the GLD is higher than it was in 2011. And this is a measure of investor sentiment because as people pile money into the GLD, new shares have to be created, right? So this shows investors are not interested in gold right now. And I just looked at the GDX. The GDX is up like 50% over the past year. Shares outstanding are down about 25% over the past year. Investors, they see what's going on, but they're not invested in the sector, and the sector is small. Like I cover the gold miners, I cover the silver miners. The silver miners, there's probably 15 producers and some smaller ones. The market cap of all of which is $20 billion. You start flowing some investor money in there, and it's like water through a fire hose at some point.
Mm-hmm. So, part of the picture for gold as well that is always brought up is this kind of compensation for inflation. And the Fed has seemingly, gotten a handle on inflation. And Powell has said recently as much. What do you see as the path forward for inflation from here?
I find the statistics, I understand them, it's annualized rate over year-over-year change.
Mm-hmm.
But the best way to sum it up, I saw something recently. It's like, 5 years ago, I weighed 200 pounds, then I gained 15 pounds and 10 pounds and 8 pounds. And then 2 pounds, and my overall rate of inflation is only like less than 2% now, but now I weigh 260 pounds, you know? And if you look at the price of food, I just saw some stuff also recently where people are posting their food bills from 3 years ago, and it was like $130 versus now, which is, you know, $320. Annualized, that's like a 25% inflation rate. So, you know, inflation is rising at, you know, 25 in the United States, actually like 25% right now. The Fed's going to cut rates. And what happens when the economy slows down and the market slows down? Inflation usually slows down. That's why they feel free to cut rates. But, you know, I don't know. The inflation is dollar based. The amount of money that the government is spending on failed policies is absolutely outrageous. And it's going to continue, and it's going to increase. So, you know, I think these are, you know, truly great times for gold, and you need to protect yourself.
Mm-hmm. Garrett, you said that gold is really sniffing out what is coming, you know, being ahead of the Fed in a lot of ways. But how does gold, you know, typically react in an actual rate cutting environment when we actually get there?
You know, based off previous history, right? It doubled. The last recessions, there were rate cuts. There was the Fed increasing their balance sheet. Gold tracked very well with the amount of debt outstanding with the Fed's balance sheet. You know, and it doubled over those previous times. You know, I like to keep it simple, and that's what I keep on looking back for comparison.
Mm-hmm. And you know, you mentioned that we've been, you know, bumping up against new all-time highs in gold. Seems like every other week here. So what do you see as the reasons for silver's behavior during this time? You know, gold keeps marching higher, and it seems that silver isn't following or can't follow.
Yeah, no, you know, silver's done pretty well. Silver's at $30 an ounce, right? You know, just a year ago, it was, you know, low 20s. Silver generally lags, and when gold really starts going higher, silver would just rip higher. You know, silver off is more volatile than gold. And you know, there's some crazy stuff going on right now tied into, you know, the government Green New Deal and DEI initiatives. And Samsung just released a battery that uses 32 ounces of silver, like a kilo of silver in these new EV batteries that goes 600 miles. They take 9 minutes to charge. That's a tremendous amount of silver. That's like 2 billion ounces if you project it to 2040 to meet their EV demand. Silver's used in solar. 20 grams per panel, and you know that's supposed to grow 10x over the next few years too. Only 800 million ounces silver is mined per year. The current demand is 1.2 billion ounces. Like current demand, the silver's been in a deficit for a supply deficit for 4 years, and it's gonna get worse. There isn't going to be enough silver to you know, to go around.
Mm-hmm. Going back to that, the Samsung battery innovation, give us a sense for how much more silver that needs rather than what technology is currently on the market.
To be honest with you, I don't know what the current batteries use.
Okay. I think from the article, it's something like 32 times more silver, because typical batteries use something like 1 ounce, and then
1 ounce.
Going to 1 kilo, which is just over 32 ounces.
Yeah,
that's an incredible increase. And then you bring in, you know, like you said, the growth in solar demand as well is just absolutely incredible. But, you know, considering how long silver has been in a production deficit for, like how do we see this condition exist, and where is that silver coming from if the market needs that much of it and less is being produced?
Yeah, silver is interesting because it's like a byproduct metal. There's billions of ounces of silver lying around in storehouses, so the above ground stock is greater, you know, in ounces than gold. But gold, you know, the bricks, you know, you keep it in a safe because it's worth a lot of money. But you know, the silver bricks, not necessarily worth as much. You keep it in a warehouse, not necessarily a safe. So there's higher available silver out there for use, but you know the demand's going through the roof. They're gonna eat through this surplus. And then, silver's been in a deficit for about 4 years now. And there's haven't been many new silver mines come online. And one interesting thing about silver is if you think of the major silver companies, Core, Hecla, was Pan American, Silver Standard, which is Pan American and Silver Standard are gold now. Like it keeps going lower and lower and lower. You get First Majestic that has a lot of gold. There aren't that many primary silver companies out there. There may be 12 good ones that are traded, but they only account for about 30% of the world's silver production per year. The majority of the world's silver production comes from large copper mines. There's one copper mine in Poland, KGHM Polska, and they're mining copper at about close to a percent. A percent of copper per ton. And then the silver is like only 6 grams per ton. The average silver mine, primary silver, is like 250 grams a ton. This is only 6 grams a ton. But through the massive volume of 50,000 tons a day, they're generating tremendous amounts of silver. So those guys, they produce most of the world's silver, probably, I don't know, like 50-60% of the world's silver. But as a byproduct, it's not a large percentage of their profits or revenue. So they basically sell that off as streams or stuff like that. Mm-hmm. And it's not very elastic. It just, the production keeps coming.
Mm-hmm. So Garrett, if we could, can we kind of get an overview of how you build a portfolio? Like, let's say what percentage to you needs to be physical silver versus speculations? And do you ever invest, as we're speaking about the gold to silver ratio right now, do you ever invest based upon extremes in that chart?
Yeah, no, because it's like 85 to 90. If you look at the long term, I think the long term is about 65. Over time, it, snaps back every once in a while. But I tend not to look at that. When people talk about historical ratios of 15 to 1 and stuff like that, I don't know. There's many. You can look at silver versus gold in the Earth's crust, as far as parts per million and stuff like that. But, my strength is analyzing the companies. I'm a CFA. I go through 10 Qs. I go through MDAs all day long. I cover 75 different companies. And I started the gold portfolio to bring you guys the truth, the best ways to play gold. And if you look at the average gold miner over the past 20 years, stock price hasn't moved. Newmont, Barrick traded the same price as it was 20 years ago. And, you wonder why that's happened. I track cash costs and all the sustaining costs for the industry. The gold price back, 20 years ago was $400 an ounce. Now it's at $2,500 an ounce. The miner's cash cost 20 years ago was $250 an ounce. And you know what it is now? It's over $1,000 an ounce. So what happens is when inflation pushes gold higher, it pushes mining costs higher. So the miners' profit margins are no higher than they were 20 years ago, which is one of the reasons why the large cap miners trade at the same price as they did 20 years ago. But there are some great ways to play gold where you can add leverage to the gold price. The number one way to do it is through, I call them IPMs, inflation protection machines. They're the royalties. They got fixed costs. They got minimal management of 2 or 3 employees versus miners at 200 to 300. They have no cost exposure to exploration success. As the mines are developed and they find more ounces, the royalties get all that for free. And so, the royalties are the best way because they don't suffer. They have fixed costs. They don't suffer from the cost inflation the miners do. And then the other way, that's one of my products, the GP. And the other one's the GP 10X, smaller explorers, developers, and miners that are trading for 100 to 200 mil market cap that can drive hundreds of mil of value with one drill hole. The main way value is created in the mining industry, it's through drilling. The majors, have trouble adding, accretive value, shareholder value, because they're paying for projects, spending hundreds of billions of dollars of projects, and they're just squeezing out an incremental free cash flow. Where you really can increase shareholder value is, by, a successful drill hole. And the successful drill holes, these high-grade drill holes, once a high-grade ore body is identified, they got to prove out the resource. So once the high grade drill hits start occurring, they continue for years as you move through inferred to measured to proven and probable, and there's value driven every step of the way. So that's what really I'm excited about. With the GP 10X, and that's what I like to talk to you about.
So all of that considered, Garrett, are there particular let's say qualities that you're looking for in these gold miners or silver miners? Is it somewhere that you're looking at on the Lassonde curve? Is it a macro environment thing? What kind of draws you to these particular miners?
Tell you what, two things mostly. It's grade, need high grades. Number two, people. The industry is very connected, right? Vancouver, Toronto, a lot of the companies are a little incestuous. They do deals amongst each other that benefit the CEOs, and they screw the shareholders. You get companies like Core Mining. When you think of silver, people go, "Oh, Core Mining." Core Mining, split adjusted, was over $200 a share back in the late 90s. Now it trades at $3. It's like a triple leveraged ETF suffering from dilution decay on a daily basis. The management got rich, the bankers got rich off the debt equity deals, and the interest and shareholders got screwed. I tend to watch, I go through all the financials. I get spreadsheets for every company. I watch the numbers. I watch what people do more than what they say. And, I've seen value creators in the industry as well. Take, for instance, Eric Fear that founded Silvercrest Mining that got taken over by First Majestic for Santorelina. And now Ermitano's joining in there, and he sold Silvercrest Mining to First Majestic, and then he kept a little portion for himself. That became Silvercrest Metals. Silvercrest Metals owns Las Chispas, one of the highest grade deposits, in the world. It's got gold and silver. They were able to pay off $40 million loan in less than a year, built a $100 million cash position. And, money talks, right? Like, show me the money. You got to find profitable miners that are making tremendous amounts of free cash flow, because good things happen to miners that generate free cash flow because they pay dividends, they buy back shares, they have good management, they're going to do smart things with the profits, and they can grow creatively. They can increase earnings on a per share basis, which drives the stock price. It's about grade and people. And then one thing regarding the grade is there's a thing called Archie's rule. There's Archie was a geologist for Noranda back in the day. And I was speaking to my friend Peter McGaugh, who founded Mag Silver, and he's affiliated with New Pacific Gold. He founded MAG on his first drill hole, and, he showed me this study by Archie, and it talked about how, in order to back of the envelope, in order to find profitable mines, you need to find mines that are going to generate 2 times the revenue as costs. That's including CapEx, that's including everything. It's kind of a basic measure. And the only thing that drives revenue higher than cost is grade. Because when you mine, right, it's fixed tonnage. It's 2,000 tons per day, 10,000 tons per day. Costs you a certain amount. In Bolivia, it costs you $25 an ounce. In Canada, it costs you $150 an ounce. In the United States, I don't know, $200 an ounce. So those costs are relatively fixed. And the only way you can increase profits is by having higher grade, right? You got more higher grade in your ore. It increases production. It increases revenue. So if you're not starting from a high grade situation, the mine's not going to be profitable. And, that leads into one thing regarding optionality in the mining space. A lot of people, they throw around this word optionality. Some of this optionality, when you hear this word, be careful, because sometimes they're talking about big ounce deposits that are not profitable at today's gold price. So that or miners that are in production that are barely profitable, and they're like, oh yeah, they're not making money now, but their costs are this, and when gold goes up to here, they're going to make this much money. It's like, because when inflation pushes gold higher, mining costs are going to follow. So these uneconomic cow pastures that have been traded and shot for 20 years are going to remain to be uneconomic cow pastures, even when gold's at 5,000, because the costs are going to, mine's still going to be uneconomic, and the costs are going to be, I don't know, $2,000, $3,000 an ounce. So, beware of leverage. But, one thing regarding leverage is, one of the best ways to play leverage in the mining space is through the IPMs, through the royalties. They sign, they pay up front for contracts. They have fixed costs. Any exploration success is, floats right down to them. You look at Franco-Nevada that paid $2 million for Gold Strike back in 1980. They received $1 billion from that already. It's going to hopefully generate another $500 million. It's crazy, the value that these royalties generate.
As we're on the topic of royalties, considering the picture of their, let's say, lessened risk versus an actual gold miner, is a lot of this priced in, and therefore the major upside in a market like this taken out of a lot of the royalty and streaming companies?
I would say over the long term, the royalties are the best way to play it, for the reasons I mentioned, as well as diversification. They have hundreds of properties, the miners only have one or two. If you get one mine going down, you're in trouble. You look at First Quantum with Cobre Panama, you look at Victoria, where their tailings dam collapsed, the stock went to zero. So they're diversified. It's a better way to spread risk. But, in a really strong gold price environment, some of the lower quality mining assets, more highly leveraged mining assets will do better. They'll ramp up 2x, 3x. But this comes back to people, because what happens with these low grade, low quality assets or low profitable assets is they're dependent upon selling shares to plug the gap in their balance sheet. And when we get a spike in the gold and a spike of silver price, their stock price is going to run up 2x, 3x, and they're going to look at each other and say, hey, we should sell more shares here. We're going to put more money in the bank. So that's what they do. And they cap every rally by selling more shares. Whereas, the royalties are more of a slow and steady ride over the longer term. And they grow without, significant dilution. A lot of the major royalty companies, they grow through internal cash flow. They don't have to issue shares. So, it's a double-edged sword. If you really think the gold price is going through the roof, you can add a little leverage in there in some of these low quality assets, but your timing's better be right. And then, that gold price environment that you're betting on only occurs like 2%, 3% of the time. The other 90% of the time, you're going to be losing money.
Mm-hmm. So to be a little bit more specific on the royalty side, what are you looking for in those companies? Obviously you mentioned people, diversification, jurisdiction. What are some of the most important things to think about when it comes to choosing the right royalties?
Yeah, money, baby. That's it. It's, you look at a company like Orogen, right? Orogen's been on my radar for a few years. They had Ermitaño that they're receiving about $6 million a year from, that First Majestic owns. And First Majestic just released drilling results on a new ore body called Navidad. And Navidad is right next to Ermitaño. It's high grade. It's a little bit deeper off to the west. And this is what I'm talking about regarding exploration upside. Now, the 5-year life of mine of Ermitaño is going to get bumped up to another 5 years to make it 10 years or even further with Navidad. And Orogen gets this for free. And that's not even the best deal because Orogen, they paid $100,000 and they spent $100,000 acquiring and exploring Ermitaño. They auctioned off their First Majestic. All they paid was $100,000. They make $8 million a year. But the Orogen story is even better because there is an asset. They own an asset called Silicon Merlin. Have you heard of Silicon Merlin?
No.
Yeah, it's owned by AngloGold, right? And again, they spent $100,000 acquiring and exploring this asset. AngloGold just came out with an initial economic forecast. They just already discovered 13 million ounces there, and they barely scratched the surface. They expect the mine, when in production, to do 1.8 million ounces a year in year two. That's going to be one of the largest gold mines in the world. That's worth $45 million to Orogen. in year 2. It's not going to be in production for another 5 years. That's $45 million. Over the life of the mine, $230 million. Origin's 1% NSR is worth. And, they only spent $100,000 on this asset. The difference between 100,000 and that, whatever, 230 million, that's shareholder equity. That's going into building shareholder value. That's profits. And then the other thing is, the majors, there's constant consolidation in the industry where the big fish eats the small fish. And the majors wait for the smaller guys to build up an asset to a critical mass, and then they swoop in and snag it. And it's happened with Mavericks, it happened at Nomad, it happened at Elite Gold, it happened at Abitibi Royalties. There's been about 20 of them that have been taken over the past 10 years. Origin's next.
Interesting. So Garrett, when we think about what needs to happen for these companies to become takeover targets, are there any particular other examples you can give us of characteristics that they present before a takeover? And is that a time that you want to be buying them?
Well, initially it's great, right? You watch the drill results, you see which projects are, uncovering high grades. That's where the value's generated. You see what royalties have exposure to those assets, and as they get proven out, the grades continue. And then, I'm able to make resource estimates off drilling studies. I'm able to build an economic forecast, for these mines based off their projected ore body. And it's all about cash. It all comes back to, how many profits per ounce, are you going to be able to get, which leads into value generation in the royalty sector. And it leads into value generation in the mining sector. And I think the Lundin family, they're involved with G Mining that just took into Zeno, and they just bought Reunion Gold. One of their lines is they're focused on all ounces are not created equal. We're only focused on economic ounces. That sort of thing. Low cost. Higher grade operations that can drive significant amounts of profits that's used to drive shareholder value. Because if you don't have that, the share price is going to struggle along. The company's going to be dilutive, and it's going to continue that way. It's not going to change.
Mm-hmm. And as we were talking about the royalties, another question that came to my mind was: are there particular structures and or ways that they create shareholder value? As in, are they paying dividends, or what is that plan for the company? Are there particular structures like that make one company more rewarding to you versus another?
Yeah, the average dividend yield is about 1.2%. It's not much higher than the GDX is like 1.1%, but the GDX's fees of about 56 basis points. So if you net the two, the royalties do end up paying more. But the big thing you get with the royalties is that exploration upside that takes years to play out. Where like Origin only paying $100,000 for a property, it's going to be worth $240 million to them, over time, and that directly drops into shareholder values versus the miners paying billions for Kinross paid whatever $3.1 billion for Redback Mining back at the last peak in 2011. They spent, I don't know, probably $1 billion developing Tacius, and for years it was a disaster, and they had to spend so much. And now they got it running right. Tacius is generating tremendous amounts of free cash flow, but they're $4 billion in the hole. Will they ever be able to recoup that $4 billion? Yeah, maybe in like 20 years. So, quite simply, you got to look at the price you paid for an asset and the profits you get from an asset. And, as a business owner, you want to get more profits as much as you can from the amount that you paid. And that's basically bottom line what I look at and what I follow. And that translates directly into, shareholder wealth creation. That's what the royalties are good at. And the royalties of hundreds of projects, all they need are one or two to get lucky. you know? And if one goes down like Cobre Panama with Franco, it's not the end of the world. It's Franco went down 20%, big deal. It was a big part of their portfolio, but they'll be fine. They have hundreds of other assets. In 2024, there's like 5 or 6 mines going in production. There's I don't know if I'm going to be able to find it in time, but Greenstone's going in production. Royalties, there's royalties on that. Tocantinzinho, and there's royalties on that. And Cote Gold is going into production. So you get these monster projects going into production. Blackwater owned by Artemis, and the royalties are getting streams from it, along the way, and that the royalties track, free cash flow on a per share basis, and as their profits and free cash flow increase, the share price is going to increase.
So Garrett, gold mining by and large is still done basically the same way it was done basically 100 years ago. So do you see any companies that are really on the, let's say, the cutting edge of increasing efficiency by using AI or any other tools to really sharpen their swords, or to be able to increase production and become more efficient as a company?
Nothing has crossed my radar yet. I've seen Hecla, the mining industry is moving more towards, automated mining, which is safer, and in time more productive. But, the software costs of, installation is, millions and millions of dollars. You see, technological advances. I know First Majestic, they put in like Hig mills, the fine grind, mills, and they've used micro bubbles now. So basically, the stuff where I see that increases, recoveries by 1% or 2%, which boosts the bottom line. That's just doing the old way. It's doing it the old way still, just doing it a little bit more efficiently. I haven't seen many, energy or AI initiatives sink to the bottom line yet in the numbers that I follow. But it's funny, right? Rob McEwen, right, who was CEO of Goldcorp for a long time with Red Lake. Red Lake was a struggling mine. And then he had a contest, right? And he said, hey, we're going to open this up. We're going to release all the drill results and everything to the whole world. And we're going to, everyone has access to it. And send me your best results. And whoever sends me the best results will win. And the best results were a home run. They followed it and they turned Red Lake into a cash cow, which made Goldcorp. So that, the whole crowdsourcing thing worked for him. But it was an interesting story, but I haven't seen it.
Sorry, Garrett, I had a little interruption. I think you were saying you haven't seen really anything at all.
No, nothing recently regarding AI. I know some companies are working on it and stuff, but there's nothing better than an old-fashioned geologist that decides to drill there just because of it smells better. The rocks smell better or something.
Mm-hmm. Excellent, Garrett. Well, we've covered quite a bit here on what makes gold miners and streamers and royalties appealing to you. Is there anything that you'd like to leave our audience to think about before we wrap up?
We're in an interesting environment right now. You always look at the price of gold, and think it's going to be spiking higher. It looks like we're in one of those environments now. People talk about the long term in the United States. It's like, in the long term, things aren't going to end well, but, when is that long term going to be? But with everything happening, with the political system, with the debt, and with the amount of interest that the government pays, it's not going in the right direction, and it's becoming worse. And it's like, are we truly in the long term right here? And, I don't know, we could be, but, in order to keep your portfolio protected, you got to own gold. And 90% of gold miners, they underperform gold over the longer term due to cost inflation and dilution and stuff like that. Whereas, the royalties over the past 20 years are up 13,000, 14,000% a basket of them. And, that's the product that I offer the gold portfolio. And then, the smaller miners, they've been suffering, for years, for close to a decade. The last big bull market was was 2011, where these things went through the roof. So, they're dying for cash. Investors are not interested. They're not involved. And, if gold really truly starts moving higher from here, like to 5,000, it's going to get wacky. Some of these smaller explorers and developers are going to go up 5x, 10x, even more, like quickly, just off drill results. And it's starting to get exciting here. And, to be honest with you, like, I'm pretty excited. Like, I'm watching the gold price. It's 25.20. It's ticking up. Except there's investors don't care. They're not exposed. I just don't see the interest. I don't see the mania yet. And based off, the GLD shares to the GLD price outstanding, and the sentiment measures that I follow, we're not even close to a mania top.
Mm-hmm. So at a mania top, as you're saying that, what do you think, really shows us that we're near one of those tops? Is it only, is it the classic line that your cab driver starts to give you gold mining stock tips?
Yeah, that, and because you're not going to want to sell your gold at that point, right? Like, it's going to it'll be, your gold's going through the roof, the dollar's going down, America's going down the tubes. You're not going to want to sell your gold. That'll be the hardest thing to do at that point. And maybe at that point, it'd be great to sell you gold, invest in more productive assets, it's technology and stuff like that. One of the interesting stories is the Homestake mine. That was a source of William Randolph Hearst's fortune. It's in South Dakota. And Dakota Gold just restarted. They bought all the land around lead, all the old Homestake claims, and they're exploring right there. They got some decent drill results, but it's a source of William Randolph Hearst's fortune. That's how his dad made all of his money, and his dad staked the money that he made in the gold mine or Homestake to his son, who started Hearst Communications. But back in the 30s, Homestake mines went up 1,000%. While the Dow lost 90% of its value. And you keep looking back to parallels, and you never want to think it's going to get that bad. But, gold was a safe haven back in the 20s and 30s. And historically, it's going to continue to be a safe haven. And if, we ever get a major correction, gold's going to do well. But one of those things regarding Homestake, the thing that really drove it, it's profits and free cash flow. They were paying ridiculous amounts of dividend back to shareholders. So, to me, it's all about money. It's all about cash. That's what you need in order to drive the share price. But, if we are indeed in the long term, gold goes crazy, the gold miners should do well. It's going to be a great place to be over the next few years.
Mm-hmm. Kind of, I guess, comes back to how a company is actually, how disciplined they are with their debt and their actual financial position to be able to really capitalize on this coming gold price, right?
Yeah, no doubt. Just, the companies that tend to dilute, they continue to dilute. It's just a constant steady flow of shares, and it's like swimming against the tide. You'll have a time where it'll double or triple, but the share selling will commence again, and bring the share price right back down because your earnings are diluted on a per share basis. It's hard. It's a hard business. It's hard to be profitable. That's why you need to follow the proven stewards of capital in the industry, the proven value creators, and the high grade opportunities, because those are the most profitable. Just the majority of mines, probably 90% of them, struggle along with marginal assets, break even production, barely profitable, and they have no choice. They have to dilute. But follow the golden portfolio, learn about the profitable ones. These are the ones that are going to deliver the most shareholder value.
Mm-hmm. Excellent, Garrett. So for those that want more from Garrett or to understand more about the golden portfolio, that's all available at goldenportfolio.com. And of course, excellent Twitter follow as well, at Garrett Goggin, 2 R's, 2 T's, 2 G's. Garrett, thanks so much for your time today.
Excellent, Tom. Thanks so much for having me.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.